Good morning, everyone. So, in this class, we are going to discuss about how important problems that are going to show up in your exams. So, I have uploaded, means I have given the link of a drive folder on this YouTube video. So, I would request you to download that link. It is it in this folder. You have the sample questions as well as the sample solutions. Pause these videos, try to solve those sample questions, and then watch it again to understand the solutions behind it. So I'm straight away going to start with solutions. Okay, so let's go by these problems one by one. So you bought this Facebook stock at $50 per share in 2005. In 2017, the stock is trading at $235. They have asked you to find out following things: dollar return, total percentage return, average return, and geometric mean. So what I'm going to do is I'm going to open an Excel file and we are going to solve that. Okay. So just a second, I'll zoom in the Excel file a bit. Okay. So what is the invested value? You had made an investment at $50 per share. And what is the final value? Final value is $235 per share, right? Another details they have given, the period is 2005 and 2017. So years, number of years is 2017 minus 2005, that is 12 years. Okay, so first they have asked you, this is the first numerical. First they have asked you dollar returns. So dollar returns are calculated as, final formula for dollar returns is final value minus initial value. So it is final value minus initial value. Second is they have asked you total percentage return. Total percentage return is final value divided by initial value minus 1. So it will be simply 235 divided by 50 minus 1. In percentage term it is 370%. Next is they are asking you to find average returns. Average returns formula is total percentage return that you calculated in the previous step divided by number of years divided by n. So it is 370 divided by 12. So it is somewhere around 30%. Then they are asking you geometric mean. Geometric mean is, or geometric returns are simply 1 plus total percentage return to the power 1 divided by n minus 1. Okay, so it is 1 plus 370% to the power 1 by 12 minus 1. So total geometric mean is somewhere around 14%. So these are the answers: dollar return, total percentage return, average return, and geometric mean. So let's move on to the second question. The second question says the stock has given returns of 19%, 13%, 11%, minus 11%, minus 3%, and 17% over the last 6 years. What are the arithmetic and geometric returns of the stock? So again it is asking for arithmetic and geometric return. So first, what are the years and what are the returns? So here is 1 2 3 4 5 and 6. Let's say the returns are 19%, then 13%, 11%, minus 11%, minus 3%, and finally 17%. They're asking you arithmetic mean and geometric mean. So how do you calculate arithmetic mean? Arithmetic mean is simply addition of all these returns divided by n, that is 6. So arithmetic mean is somewhere around 7.67%. Okay, geometric returns formula is little tricky, so I'll write down the formula first. So it is 1 plus I1, that is year returns in year 1, plus 1 plus I2, let's say R symbolizes return, so 1 plus R1 return 1 year, plus 1 plus R2 multiplied by multiplied by 1 plus Rn, and it goes on till 1 plus Rn, to the power 1 by n minus 1. Okay, so 1 plus R1, 1 plus return in year 1 multiplies by 1 plus return in year 2, return 3, 4, 5, 6, go on till n, and to the power 1 by n minus 1. So this is the formula for calculating geometric mean. So what we have to do, so it is 1 plus return yearly return 1, return in year 1, plus 1 plus return in year 2 multiplied by 1 plus return in year 3 multiplied by 1 plus return in year 4 multiplied by 1 plus return in year 5 multiplied by 1 plus return in year 6. Now raise it to the power 1 by n, that is 6, and finally subtract 1. So geometric return is 7.08%. So whenever you are solving it in calculator, do 1.19 multiplied by 1.13 multiplied by 1.11 multiplied by 1 minus 11%. So it is somewhere around 0.89, 0.97 and 1.17. Multiply all of these and then raise it to the power 1 by 6. Okay, so this solves the second question. The third one, calculate portfolio risk and return for following portfolio. They have given weights, so I'll just copy paste it and then we can solve it. Okay, so this information is given: weight in asset A, WA, WB, right, return, standard deviation, return, standard deviation, etc. So they have asked you for portfolio return of portfolio, and they are asking you for portfolio risk, so standard deviation portfolio. So what is formula for return in portfolio? So the formula for return in portfolio is weight of asset A multiplied by return of asset A plus weight of asset B multiplied by return of asset B. Please note, in return formula we are not using standard deviation or correlations anywhere. So it is simply weighted average return. So weight of asset A multiplied by return of asset A plus weight of asset B multiplied by return of asset B. So equals 0.6 multiplied by 1 0.2 0.12, right? So weight of asset A multiplied by return of asset A plus 0.4 multiplied by return of asset B 0.6. So your portfolio return is 9.60%, and that's the answer. Now portfolio standard deviation, the formula is square root of, so you have to take a square root, weight of asset A whole square multiplied by standard deviation A whole square plus weight of asset B whole square multiplied by standard deviation B whole square plus 2 into weight of asset A into weight of asset B into standard deviation A into standard deviation B into correlation AB. Okay, so this is the formula. So what we can do in the exam is try to solve this formula not in one go, but means do it in parts. So part A will be this thing, weight of asset A square plus standard into standard deviation A square. Part B will be weight of asset B whole square into standard deviation B whole square, and part C will be this entire bracket. So addition is the differentiator, we'll do it in parts. So part A, B and then C. Okay, so let's solve for part A first. It is 0.6 whole square multiplied by standard deviation of asset 7%. So 7% whole square. Okay, B will be 40% whole square multiplied by standard deviation 3, so 3% whole square. Okay, 3 will be 2 into 40% into 60% into 7% into 3%. Okay, so we have solved the three parts. The next step will be addition of all these three parts, and the next step will be square root of the addition. Okay, so addition of this part will be sum and then we have to take the square root to find portfolio risk. So your portfolio risk is 5.40%. Okay, just checking whether I've done it right. Yep, I have missed out the correlation part, so that was I was missing. into 75% is the correlation. So the answer is 5.16. So solve for part A, part B and part C separately. Add them up and then take a square root. Next is fourth one. So it's a dividend discount model problem. So I'll copy paste it, then we'll solve. So the question is about dual stage dividend discount model. So these are the details given. So what have they given to you? This first you need to identify dividend next year. So is it D0 or D1? It is D1. So they have given stated away D1, $35. Then dividend expected to grow for next 5 years is 5%. So G1 they have given, that is 5%. Then G2 is 3% in perpetuity. And finally discount rate K at 8%. Okay, now how to solve this problem? So it's a dual stage dividend discount model. We solve it for finite first and then for infinite. So for finite, so dividends, then I'm just minimizing it, present value factor, present value. This is our format. So we have D1 to D5, okay, as dividends. So what are dividends? Initial dividend is 35. Dividend next year they have given. So D1 they have given. D1 is growing for next few years at 5%. So G1 is 5%. So 1 plus, 35 multiplied by 1.05. It is growing at 5%. D3 will be D2 will grown at 5%. D4 will be D3 growing at 5%. And D5 will be D4 growing at 5%. So in the exam, 35 multiplied by 1.05 is D2. 36.75 multiplied by 1.05 is D3. 38.58 multiplied by 1.05 is D4. And 40.5 multiplied by 1.05 is D5. Okay, so multiply everything, grow everything by 0.4 by 5%, that is G1. Present value factor, initially it is 1 divided by 1 plus discount rate. Discount rate is 8%, so 1 plus 8%, right? Next year it is simply previous year divided by 1 plus discount rate. So this is the present value factor. Present value is simply multiplication of these two. Okay, now we know intrinsic value for finite period is simply addition of all these numbers. Okay, now for infinite period, we need to find D6 first. So how do you find D6? So it is D5 growing at 1 plus 3%. Okay, so find D6. Please remember, don't grow it at 5% now, because the growth rate has gone down to 3%. So D6, that is dividend, the first dividend you are getting in infinite period is the previous dividend growing at 3% now. Now we all know the formula. P0 equals D1 divided by K minus G. This is the formula for dividends in infinite period. growing at a constant growth rate. So we always have P0 equals D1 divided by K minus G. We have D6 now. So value that you will get is P5. So value you get it here. So P5 equals D6 divided by K minus G. K is 8% and G2 we have to use, that is 3%. Okay, so 876. Now intrinsic value for infinite period equals 876 discounted to present value. So multiplied by present value factor 596. So this plus this, the answer is 750. The total intrinsic value is addition of intrinsic value for finite period and intrinsic value for an infinite period. So what are we doing in such problems? Solve for infinite period separately and then solve for finite period separately. Okay, add them up, that is your final answer. We first solve for finite, then we solve for infinite. Okay, the fifth question. So it is dividend discount model again. Okay, so copy, paste, so this has a small error, that is 6 years. Then I'll explain. So what have they given? The difference between previous question and this question, they have given dividend that you have received. So they have given you D0, not D1. D0 is $40. Okay, then they have given G1, that is 5% again. G2 is 3% and discount rate K is 8%. Okay, now they're asking you for intrinsic value. So again we have to find intrinsic value for finite and infinite. So we require dividends, then present value factor, present value. Okay, dividends are D1 to D6 now. Their finite period is till D6. Okay, dividend is $40. D0 is $40, so D1 will be 40 multiplied by 1 plus growth rate in finite period, that is 5%, 42. Next dividend will be previous dividend multiplied by 1 plus 5%. Okay, and so on. Present value factor, like we know, it is 1 divided by 1 plus discount rate. Discount rate is 8%. Next present value factor is previous value divided by 1 plus discount rate. Okay, present value is this multiplied by present value factor. Okay, intrinsic value is simply addition of all these present values. So once again, how do you solve for dividend discount model for finite period? You plot those dividends, right? So dividend is growing at a constant rate, so you plot those dividends, calculate the present value factor. Present value factor is 1 divided by discount rate, so we are finding the value today of $1. So $1 after 6 years, if you're getting $1 after 6 years, it means you're actually getting 0.63 cents in today's term if discount rate is 8%. Then present value is simply dividends multiplied by present value factor, and intrinsic value for finite period is simply addition of all of that. Now for infinite period, we require D7, the first dividend that you get when the infinite period starts. Now D7 is previous dividend which grows at G2, that is 3%. So this is D7. D6, or the previous dividend, the last dividend in finite period growing at G2. Okay, then it is simply, we know the formula, P0 equals D1 divided by K minus G. So we have D7 now instead of D1, so we will get P6. P6 equals D7 divided by K minus G, that is 8% minus 3%. Okay, but this is value in the 6th year, we require value today. So intrinsic value for finite period, I'll just copy paste it. Intrinsic value for infinite period will be simply value that you're getting in 6th year multiplied by present value factor, and addition of these two is your answer. Okay, the next question is Sharpe, Turner and Jensen's alpha. If the risk-free rate is 7%, so they have given some details, and the risk-free rate they have given us 7%. So let's try to solve that. Oh, it has been a half-hour recording and I am doing it at 5 o'clock in the morning. Oh my god. But we are on the threshold of World War III right now. Let's see how that folds up. So Syria was attacked yesterday, right? So maybe World War III and the world ends. So me waking up at 5 o'clock or 4 o'clock in the morning, it is immaterial if the world ends. Ah, it will not end. We have been through Cold War, nothing happened. So risk-free rate. You should be more bothered about Thanos attacking the world than Russia attacking the world. Yeah, Avengers Infinity War. Do watch it. Risk-free rate they have given us 7%. Am I right? Yep. Risk-free rate is 7%. Okay. So these are the details given. Portfolio PQRS, market return, right? Markets details are given, returns are given, betas are given, standard deviation. They are asking you to find Sharpe ratio, trainer ratio, Jensen's alpha. Okay, alpha is done in two steps, so you need to find expected return and then you need to find alpha. Now what is Sharpe ratio? Sharpe ratio is nothing but return of portfolio minus risk-free rate divided by standard deviation. Turner ratio is return of portfolio minus risk-free rate divided by beta, or beta as it called. You can call it beta or beta, whatever. Expected return is CAPM return. So the formula for that is risk-free rate plus return on market minus risk-free rate into beta. Please note we are not using portfolios return, we are using market return, but beta of the portfolio. So beta of portfolio, and alpha is simply return of portfolio. Return, why it is okay, my computer does this sometime. I need to buy a new one. So return of portfolio minus expected return, that is your alpha. So let's do it. Sharpe ratio, it is simply return of portfolio minus risk-free rate. I'm making it constant. I need to change my computer. Stop buying drones, buy a computer. Divided by standard deviation. Okay, so I'm just dragging it. You cannot do it in exam. Calculate these values for each portfolio. Market we don't require, we are only ranking portfolios. Market is irrelevant details. Okay, so 1.6, 1.3, 1 and 1.7. so Sharpe ratio always higher better. So higher the ratio, better it is, because it gives how much return the portfolio is generating for 1 unit of total risk that it is undertaking. So higher the return, better it is. So ranking will be S, P, Q and R. Highest first, so S, P, Q and R. Then trainer ratio. Trainer ratio simply return of portfolio minus risk-free rate divided by beta. Now instead of standard deviation it is beta. Here it was standard deviation, here it is beta. Drag it. Okay, again higher better for even Sharpe ratio, even trainer ratio. So higher better means the highest is S. Okay, then it is Q, S, Q, P and R. S, Q, P and R. Okay, the third is calculating alpha. Two-step process, calculate expected return or CAPM return and subtract it from portfolio. So what is CAPM return? Risk-free rate 7% plus return on market 13% minus risk-free rate 7% multiplied by beta. So this is expected return. What is alpha? Alpha is return of portfolio. So it is return of portfolio minus the expected return. This is your alpha. Again, alpha is return over the expected return. So higher better. So ranking will be, so for my understanding this was P, Q, R and S. So ranking will be highest is Q, then we have S, then we have R, no, P, Q, sorry, Q, S, then P, and then R. This is the ranking. Okay. Now this is solution to sixth problem. Seventh problem, I'm going to tell you how to do it, but I'm not going to do it for you. Okay. It's an image or it's an Excel file. Okay, let's do it otherwise. Not fair. I am doing everything for you. I know. The seventh problem. These are the details given. So it is actually Nike's ratios. So I hope it is visible. Okay. So what do I expect from you in the exam? You have to first calculate horizontal analysis or trend. So it is called as trend. The better way is trend of the ratio. Then you need to write the interpretation, right? And then you need to write the reasoning. Okay, reasoning of the interpretation. So trend is simply current ratio divided by previous ratio minus 1. So in percentage, return on asset has fallen by 11%. So bad, reasoning is bad, reason means interpretation is bad, reasoning lesser return on assets. Okay, next return on equity, again current ratio divided by previous ratio minus 1. So percentage wise it is 7%. Reasoning, it is bad, lesser return for equity holders. Okay, EBITDA margin current value divided by previous value minus 1. So again a fall, 6%. Reasoning, it is bad, operating efficiency has gone down. Okay, next is net profit margin, down, it's 9%, bad. So total efficiency has gone down. Okay, total asset turnover is same, almost same. This is also same. Even it's very close. Account receivable turnover is same. So neutral. Neutral and neutral. Okay, interpretation will be efficiency of using total assets is same, efficiency of using fixed asset is same, cash to credit sales is same. Okay, how you are converting your credit sales into cash, it is again same. Current ratio has fallen, so it's 2.5 divided by 2.9 minus 1. So that is bad, 13% it is gone down by. So liquidity going down. Okay, even quick ratio is going down, so it is 1.5 divided by 1.8 minus 1. So 16%, that is also bad. So liquidity again going down. Means quick and current both indicate liquidity. Quick is better because it doesn't consider inventory, that is generally illiquid. Then total debt to equity ratio, debt going up 31%. So it depends on the environment, it can be good or bad taking leverage, but risk has gone up if you increase the debt. The risk of doing business is up. Okay, then interest coverage ratio is down. So it is 41 divided by 55 minus 1, it is down by 25%. So that is bad. Lesser profits to cover interest payments. Okay, P ratio has gone up. So minus 1, 28 divided by 24 minus 1. So that is bad actually for a new investor. So company is more costly now. Okay, price by book value has also gone up. So assets are more costly now. So this is how you have to interpret ratios. Calculate the trend, right? Trend is current value divided by previous value minus 1, and then write down reasons, good, bad, write down interpretation, and then the reasoning. Okay, eighth question, my favorite part. So this is the chart that is given to you. It is Tesla's chart and it is United States. So Tesla is currently trading at this price. Okay, they are asking you to do what? Find out entry, exit, and stop loss based on support and resistance for, it's not Facebook, it is Tesla. So we have to find out entry based on support and exit means entry based on resistance, then exit and stop loss for both of them. So we have to identify support and resistance. What do you do on support? You go long. What do you do on resistance? You go short. What is support? Support is the valley pattern that is created. Resistance is the peak pattern that is created, or the mountain pattern that is created. Now can you see this valley? So what do you do in valley? Find out the lowest red candle and identify the base of that red candle. Okay, so it is lowest red candle. I am zooming in. So lowest red candle and base of it. So if I am not wrong, it is somewhere around 250. So this was 8th. So first we are identifying support. So on support you go long. Your entry is 250. Now we have exit and stop loss. We have discussed that we generally follow 1:3 risk reward ratio. So you are going long, so profit will be up, loss will be down. If the stock goes up, it will be profit. If the stock goes down, it will be loss. So exit will be exit and stop loss will be based on ATR. What is ATR? Average true range. So average true range is given in the file below. It is somewhere around 20 now. The chart, the different chart, the below chart, it is 20. So exit will be profit. So this plus 3 times 20. Risk to reward 1 is to 3. 1 is the risk, 3 would be reward. So you would enter at 250. If the stock goes to 310, you will exit. Or you enter at 250. If the stock goes to 230, the stop loss hits and you exit. So loss is $20, profit is $60. That is the game. Then again, resistance, we go short. Okay, entry, exit, and stop loss. So let's identify the resistance now. Resistance is the peak pattern, the mountain pattern. There are two peaks. The closest peak is this, and the base of the tallest green candle there. So tallest green candle is this. The base is somewhere around 340. Yep, 340. So entry is 340. Now you are going short. So if the stock goes down, you make money. If the stock goes up, you lose money. So exit will be, ATR is 20. So exit will be 340 minus 3 times ATR. This will be your profit, and stop loss will be 340 plus $20. So you are entering at 340. If it goes up and you start making losses, you will exit at 360. If it goes down, you will exit at 280 to make money. Risk is $20, profit is $60. 1:3 risk reward ratio. Whew. We are finally there on the last question. Yeah. So you have bought a stock in margin. So let me save this file. You have bought the stock in margin. Oh, where did it go? I don't have to save this. I've already solved it and uploaded the file for you. Okay. I need a coffee after this. Yep. Coffee it is. The 9th question. You have bought a stock in margin. You have traded long. The following details are given. The stock price is 52. Margin is $50. 50%. Maintenance is 30%. Interest cost is 8% per annum, and duration of the trade is 3 months. So let me copy this, put it here. What I'm doing did not get copied. It's a long trade you are doing. Okay, this is the long trade. Now few details. Initial margin is 50%. So out of $52, you only have to put 50% as margin. So your margin, initial margin will be $26. So how much is the loan? Loan is full price minus the margin amount, that is 52 minus the margin amount. $26 is the loan. Maintenance margin is 30%. So 52 multiplied by 30%, that is 15.56 is the maintenance margin. You have to maintain this much amount in your margin account to stay in the trade, otherwise you have to exit. Then interest that you are paying on this trade, interest is paid on the loan. So $26 is the loan, multiplied by 8% is the interest, but this is annual interest, right? You are trading only for 3 months, so 3 divided by 12, that is $52 is the interest. Okay, Now what are they asking you? They are asking you dollar terms profit, percentage terms profit. So let's calculate that first. So first, dollar profit. Dollar profit is how much is the stock going to? Case 1, stock is going to $69. So dollar profit will be 69 minus you entered at 52, right? So you entered at 52, now it is at 69. You have made profit minus the interest. This is dollar profit 16.48. Then percentage profit will be dollar profit divided by invested amount. How much did you invest? You did not put $52, you invested only $26. $26 was the loan. So 63% is the dollar profit. What is the amount there would be in margin? So in margin you would have $26 that was deposited by you plus profit on the stock. Do not consider interest, you pay interest separately. So 69 minus 52, so $43 will be there in your margin account. Do you get a margin call? If yes, what is the variation margin? So do you get a margin call? Maintenance margin is $15. You have $43 in your account. So no. If your margin account goes below maintenance margin, only then you get a margin call. So no, you do not get a margin call. Okay, this was case 1. Case 2, they are saying the stock goes to $29. Okay, what happens? So dollar profit or loss? So dollar loss would be there. So it is 29 minus 52 is what are you entered at, minus the interest payment. Okay, percentage profit, it is simply this divided by $26 that you invested. So 90% you have lost. How much will be there in your margin? So you had $26 in your margin, and how much is the loss excluding the interest? It is 29 minus 52. So I am just changing the signs. So you are left with $3 in your margin account. What is the maintenance margin required? $15. You only have $3 now. So do you get a margin call? Yes, you get a margin call. Okay, so you have got a margin call. Then you need to put variation margin. Variation margin is always initial margin of the current stock price. So current stock price is $29. So $29 multiplied by 50% you need to have, right? And you currently have $3. So stock price multiplied by initial margin minus the current margin amount, that gives you variation margin. So you have to put in $11.5. So that solves all the questions. These are important. Watch this video before coming to the class, means before coming for the exam. Thank you.